John Bogle, founder of Vanguard, was a true revolutionary in the world of investing. He wasn't just another financial expert, he was a visionary who saw the potential for a more equitable financial system. Bogle's mission was to democratize investing, making it accessible to everyone, not just the wealthy elite. He believed that the average person deserved the same opportunities to grow their wealth as the big players on Wall Street. His approach was grounded in common sense and simplicity, which resonated with millions of investors around the world. He believed in a simple idea that ordinary investors deserve a fair shake. This belief was the cornerstone of his philosophy and the driving force behind his innovations. Bogle was convinced that the financial industry was overly complex and often worked against the interests of the average investor. He wanted to change that by providing straightforward, low-cost investment options that anyone could understand and benefit from. His vision was to create a level playing field where everyone had the chance to succeed. His weapon of choice? The index fund. This innovative financial product was designed to mirror the performance of a specific market index, such as the S&P 500. By doing so, it offered investors a way to achieve broad market exposure without the high fees and complexities associated with actively managed funds. Bogle's introduction of the index fund was a game changer, providing a simple yet effective tool for building long-term wealth. It was a revolutionary idea that challenged the status quo and empowered ordinary investors. This simple investment vehicle tracks a specific market index, like the S&P 500. By doing so, it eliminates the need for expensive fund managers and reduces the costs associated with investing. The beauty of the index fund lies in its simplicity and efficiency. It allows investors to capture the overall performance of the market, which historically has been a reliable way to grow wealth over time. Bogle's creation of the index fund was a testament to his belief in the power of simplicity and common sense. Bogle's creation of Vanguard and its low-cost index funds changed the game, giving everyday people a powerful tool to build wealth. Vanguard's approach was revolutionary because it focused on minimizing costs and maximizing returns for investors. This was a stark contrast to the traditional financial industry, which often prioritized profits over the interests of its clients. Bogle's vision for Vanguard was to create a company that truly served its investors, and this ethos has remained at the core of Vanguard's operations to this day. Bogle's book, The Little Book of Common Sense Investing, distills his decades of experience into an accessible guide. In this book, Bogle shares his insights and strategies for successful investing, emphasizing the importance of low-cost index funds and the power of long-term thinking. The book is written in a straightforward and engaging style, making it easy for anyone to understand and apply Bogle's principles. It's a valuable resource for both novice and experienced investors, offering timeless advice that can help anyone achieve their financial goals. It's a must-read for anyone who wants to take control of their financial future. Bogle's wisdom and insights provide a roadmap for building wealth in a sensible and sustainable way. By following the principles outlined in the Little Book of Common Sense Investing, investors can avoid the pitfalls of high fees and complex investment strategies, and instead focus on simple, effective methods for growing their wealth. Bogle's message is clear and empowering. Anyone can be a successful investor with the right knowledge and approach. Bogle's message is clear. You don't need to be a Wall Street whiz to succeed in the market. His philosophy is built on the idea that investing should be accessible to everyone, regardless of their background or financial expertise. By focusing on low-cost index funds and long-term strategies, Bogle showed that anyone could achieve financial success. His legacy continues to inspire and guide investors around the world, proving that common sense and simplicity are powerful tools in the world of finance. Index funds are like giant baskets of stocks or bonds that track a particular market index. They're designed to mirror the performance of a specific segment of the market, such as the S&P 500 or the total stock market. By doing so, they offer a simple and effective way to invest in a broad range of assets without having to pick individual stocks or bonds. This makes them an ideal choice for both novice and experienced investors who are looking for a low-cost, low-maintenance investment option. For example, an S&P 500 index fund holds shares of all 500 companies in the S&P 500 index. This means that when you invest in such a fund, you are essentially buying a small piece of each of these companies. The S&P 500 is often considered a benchmark for the overall US stock market, representing a diverse cross-section of industries and sectors. This diversity helps to spread risk and can lead to more stable returns over time. When you buy an index fund, you're buying a tiny piece of all those companies. This means that your investment is automatically diversified across a wide range of assets. Diversification is a key principle of investing because it helps to reduce risk. By spreading your money across many different investments, you are less likely to be affected by the poor performance of any single asset. This can provide a more stable and predictable return on your investment. This approach offers instant diversification. Instead of having to research and select individual stocks or bonds, you can achieve a diversified portfolio with a single investment. This not only saves time and effort, but also reduces the likelihood of making poor investment choices. Diversification is one of the most effective ways to manage risk and can help to smooth out the ups and downs of the market. You're not betting on the success of a single company. You're betting on the overall market. This means that your investment is tied to the performance of the entire market, rather than the fortunes of any one company. While individual companies can experience significant volatility, the market as a whole tends to be more stable. By investing in an index fund, you are aligning your investment with the broader market trends, which can lead to more consistent returns over time. Index funds are passively managed, meaning they don't try to beat the market. Instead, they aim to replicate the performance of the market index they track. This passive management approach has several advantages. It typically results in lower fees and expenses compared to actively managed funds, where fund managers attempt to outperform the market through frequent trading and stock selection. Lower costs mean that more of your investment returns stay in your pocket. They simply aim to match its performance, which, over the long run, is a very effective strategy. Historical data has shown that the market tends to rise over time, despite short-term fluctuations. By matching the market's performance, index funds can provide steady growth and help investors build wealth over the long term. This makes them an excellent choice for those who are looking to invest for retirement or other long-term financial goals. Actively managed funds, on the other hand, have portfolio managers who constantly buy and sell stocks. They try to pick winners and avoid losers, aiming to outperform the market. Sounds great, right? Here's the catch. These funds come with high fees. These fees eat into your returns, making it harder to reach your financial goals. Bogle argues that the vast majority of actively managed funds fail to beat the market over the long term, making their high fees even more difficult to justify. The Little Book of Common Sense Investing is packed with timeless advice. Bogle emphasizes the importance of keeping costs low. He argues that every dollar you save on fees is a dollar that stays invested and working for you. He also warns against the dangers of market timing, trying to predict when to buy low and sell high. Bogle argues that it's virtually impossible to time the market consistently and that investors are better off staying invested for the long haul. Section 5, Time, Not Timing, the investor's greatest ally. Bogle firmly believed that timing the market is more important than timing the market. He stresses the power of compound interest, often referred to as the eighth wonder of the world. Compounding allows your returns to generate even more returns over time, creating a snowball effect. The longer you stay invested, the more this powerful force works in your favor. Section 6. The beauty of simplicity, index funds as the core. Bogle advocates for building a simple, diversified portfolio with low-cost index funds at its core. He suggests a portfolio that includes both stock and bond index funds, with the specific allocation depending on your risk tolerance and time horizon. This approach provides broad market exposure and minimizes the impact of any single investment on your overall portfolio. Section 7. Beyond the index, diversification and asset allocation. While index funds should form the foundation of your portfolio, Bogle also recognizes the importance of diversification beyond just stocks and bonds. He suggests considering international investments to further spread your risk. Asset allocation, the process of deciding how much to invest in different asset classes, is another crucial aspect of Bogle's philosophy. The right asset allocation for you will depend on your individual circumstances, goals, and risk tolerance. Section 8. Staying the course, discipline in the face of market volatility. Investing can be an emotional roller coaster. Markets go up and down, sometimes dramatically. Bogle stresses the importance of staying disciplined and sticking to your long-term plan, even when the market gets bumpy. Remember, short-term market fluctuations are inevitable. What matters most is staying invested and riding out the storms. Section 9. Unlocking Wealth, a common-sense approach for everyone. John Bogle's The Little Book of Common Sense Investing is more than just a financial guide. It's a roadmap to financial freedom. This book distills decades of financial wisdom into simple, actionable advice that anyone can follow. Whether you're a seasoned investor or just starting out, Bogle's principles are timeless and universal. Bogle's message is clear. Investing doesn't have to be complicated. He advocates for a straightforward approach that focuses on low-cost index funds, which have consistently outperformed most actively managed funds over the long term. By avoiding the pitfalls of high fees and frequent trading, you can keep more of your hard-earned money working for you. By embracing simplicity, keeping costs low, and staying invested for the long term, you can unlock wealth and achieve your financial goals. Start investing early, stay the course, and let the power of compounding work its magic. Compounding is the process where your investment earnings generate their own earnings, creating a snowball effect that can lead to substantial growth over time. And let the power of compounding work its magic. The earlier you start, the more time your investments have to grow. Even small, regular contributions can add up significantly over the years. It's not about timing the market, but time in the market. Remember, in the world of investing, common sense can be your greatest asset. Stick to the basics, avoid unnecessary risks, and focus on the long term. With patience and discipline, you can build a secure financial future. So, take a page from John Bogle's book and start your journey towards financial independence today.